Welcome to the Army Roundtable. Today is the 10th of July, 2019. So welcome. Tim and I are kind of transitioning with the road trip. So hi, Tim. Nice to have you with me.
Good morning.
And before we get too far into it, just a normal disclosure: Airmere Corporation is not a broker-dealer or an investment advisor. It's for educational purposes only. Options and futures involve risks that are not suitable for all investors, and past performance is not indicative of future results. So if you'd like to read the whole thing, just pause the recording if you're not watching it live, or go to the bottom of any of our web pages, and we've got it all there. So the purpose of this roundtable is to kind of talk about the road trip trade transition. So as you may or may not know, Dan Harvey, he created the trade originally, and Dan and I have been running it for, a couple of years, 3 years maybe. But Dan's, in his 70s, and he and his wife want to kind of enjoy life while they have the ability to do that. So Dan's kind of shuffling off stage left, and Tim's coming in from stage right. So Tim's replacing Dan on the SPX side of the trade. So, and you've already got a couple of trades open. In fact, Dan's last trade expires on Friday, so he's almost done with it. And Tim, you've got your 16 August and your 20 September. Now, I know the road trip has gone through a few evolutions as far as what the students are looking for and the trade performance and stuff. Dan likes to sell calls against his road trips, so they kind of end up being like Iron Condor, Weirdo type of trades. Dan was written up in Stocks and Commodities magazine years ago as a Iron Condor trader, but he's obviously morphed from that. But those short calls have caused Dan's performance to suffer a bit. I think in his personal accounts, he hasn't been as hard hit by it because he's a day trader as well. So he does a lot more trades in his personal accounts than he does in the class. And that was one of the complaints at one point, was that there were too many trades to keep track of. So Dan kind of scaled back on the trades, but he was still selling those calls, and into a bull market that can only cause problems. But Tim, you're taking a slightly different approach. If you do sell the calls, which you normally do at trade launch, I think, if they start causing you problems, you kind of get rid of them. So I think your current trades don't have any upside risk.
The August one, correct, does not. September, I did sell calls, but like you say, I don't like telling them, and I'll be taking them off before too long, especially if we go up.
Okay, so can you basically talk about the big picture of your thoughts about how you trade the road trip versus maybe what you've seen with Dan?
Okay, well, I want to get back to, I guess, what you used to call road trip light, or the original way, and I don't want to do so much activity. However, I'll do what I need to do to make the trade work. So I generally won't be doing calls on the top or layered butterflies or some of that layering stuff that we did for a while there. Instead, I'll try to keep it along the concept of light, which is reverse Harveys, risk reversals, or put debit spreads to the downside, and try to make the trade work. The problem is sometimes you need to do more than just that to get it where I want it to be. So I will judiciously do those things, but not all the
time. So I know, like, some of the trades that Dan have in his expirations, when I was closing them out in option view, sometimes they have over 100 transactions, legs, like one butterfly would be 3 legs.
Yeah.
So I think, if you're doing like what Dan was doing and having lots and lots of adjustments at one point, that kind of gets away from the idea of a road trip trade that you can put it on and kind of let it sit for a while.
Yeah.
So you're kind of getting back to the original concept, it sounds like, of just doing as few trades as possible, but still have good positive results and, minimize the risk.
Yes. Partly because, I want to minimize the risk and have it simple as possible, and partly because, if you trade too much, it can make it actually more difficult to make profit. So, I'm aware of that as well. I'm trying to keep it simple. Now, that might mean that in some cases, instead of a full $1,000 per 10 lot, which is what my target is, I might end up with less than that. But I should have a higher possibility of profit, if you know what I mean,
Right.
because of that.
Yeah, I mean, this is your August 16th trade. So obviously it doesn't look like a road trip at the moment because the market's moved up so far. It's beyond the main part of the tent, and we're kind of looking at a couple of vertical spreads essentially, but the trade above what, about 2770 or so is all profit.
Yes, there's no risk to the upside on this one. I guess we dive right into this one. There's no risk to the upside. I don't have calls on anymore. I did, and I rolled them up twice on this trade, and then I said, finally, this is nuts. I'm not doing it anymore. So I took them off. This upper expiration line, let's see if I can make it show better. If you look at just that part of it, it's still positive. It's positive by 470 by the expiration. So I've managed to not lose that, if you know what I mean. But ideal world, I'd like that to be higher. And I may make another put debit spread, put credit spread type adjustment to raise that. But at this point in the trade, we're about mid-trade. There's still opportunities.
And so you were talking about your profit targets. I know Dan never had those. I think that's something that you came up with, isn't it?
Oh yeah, okay, right. So I watched Road Trip since the early days, and have been trading it since the early days. And at least in that market at that time, it became apparent to me that if you try to make $300 or $400 per lot, and per lot I mean a one lot. So this is a 10 lot trade. I'm talking about the lot size of the original butterfly, not all the stuff you might do to it, but the original butterfly. If you try to make $300 or $400 per lot, you're really making it work hard, and it's possible, but by pushing it so hard, you're increasing your risk. You know, an analogy that I think of is in the world of telescopes, you're looking at the moon or the stars or something, and you can increase the magnification higher and higher and higher. But there's a limit beyond which it starts to get fuzzy images, and that has to do with the optics and all that. And it's the ratio of the size of your reflecting mirror to the magnification you have. And so with that in mind, I came up with what I think are reasonable profits without making this trade work really hard to produce them. And that number is about $100 per lot. So a 10 lot, I'll have a $1,000 profit target. And then occasionally, if the market stays throughout the trade in the sweet spot, which is generally from the top of the main butterfly to 50 or 60 points above it, if that happens, it's actually reasonable to get up to about $200 per lot. Number one, you won't have to make any adjustments, and number two, this is the sweet spot where the T+0 line can actually go above the expiration line, and I can show that if you want. So occasionally 200 per is reasonable. 100 per lot is generally my target. If I reach 100 per lot, like on a trade like this, especially mid to late in the trade, I would probably be closing the trade at that time. Because I don't want to push it too hard and take on extra risk to try to make more.
And then a 10 lot would use about how much margin in a Reg T account, would you say?
That's the other thing that maybe I do different from Dan, is I have a limit on that as well. I'm looking for the margin, and I'm talking about Reg T margin, to be $3,000 per lot or less. Now here, at least what it's showing us is it's $3,142 per lot, or $31,420. So I've gone over slightly on this one, but I have also done things to manage my margin as I make adjustments. And I like to start out, if I can, at less than the limit so that I can grow it by reverse Harveys without having to control the capital. But when I reach that limit, then every adjustment that I do that would raise the margin also includes the capital control adjustment, which is rolling up some of these bottom longs.
Capital control adjustment's a new term for road trip traders.
Sorry. Yeah, that's my term. That's what I call it, or CE, capital efficiency. That's from another venue, but um, it's nothing that we haven't done before. It's just taken some or all of these bottom longs and rolling them up so that my margin doesn't exceed my limit. That's all it is, and
Right.
that's a put debit spread adjustment.
So like
So
a double reverse Harvey type of thing.
he's called it double reverse Harvey. Yeah, right. Um, let's see. I can't show you here because it was actually done as part of this custom condor, but you can see right here, here's where I sold two of the bottom longs at 25.95 and I bought two at 26.10. That was the capital control part of that adjustment.
Right.
So I hope that makes sense.
So with the roughly $30,000 per position, you're planning on having what, three maximum open at a time or two?
I think I'll have three open. Um, for that'll be the maximum. It'll
So the margin
probably
shouldn't go over roughly 90,000 for the model account.
That's the plan. Yes, right.
Okay.
Yep. And I'm going to try to do monthlies, the monthly expiration cycle, but depending on when it's time to open a new one and when I've closed out an older one, I will use the weeklies or the quarterlies as well. But I think it works just as well. It's just a different cycle. But for now, I'm just in the monthlies.
So what are your thoughts? I mean, we're at all-time highs at the moment. The market could keep going higher, of course. How do you plan to trade the road trips in a grinding up market like we've been having?
Mm-hmm. So first of all, I plan to, especially now we're all-time highs. This trade has gone up 210 points from where it was when I opened it on, I think it was May 29th. Um, I even more than ever don't want to have call credit spreads up here.
Yeah,
I did do that on this one, but at that time it hadn't yet gone up 200 points from when I opened it. But now that that's happened, there's no way I'm going to have calls up here. And then the other thing that I'm doing is I don't manage these by the delta, but I do watch it. Okay, and I have a general rule of thumb in my head that I generally don't want the delta to be more than plus or minus 10 per lot. I'm sorry, 1 per lot. Sorry, I would be
right. So a
plus or
10
minus.
lot, 10 delta is kind of your target.
Yes, and
Okay.
so if I click way up here somewhere, well, delta's never going to get bad on the upside, but on the downside, I think it's whenever updates. Oh, somehow I'm not seeing that the way I want to see it. Let's see. Oh, let's reset all these. This one's being slow. I'm not sure what's happening here. I'm not seeing these deltas update like I'd expect them to, but I do watch that. And so if delta on a 10 watt gets to be higher than positive 10 or lower than negative 10, it gets my attention kind of thing. It's an alert, you might say. And then I'll start looking for adjustments to make to get that more under control and also do all the right kinds of adjustments we need to do.
Right. And then as far as defending a downward market, what's your philosophy for that?
Uh, my go-to uh, approach is going to be put debit spreads. So let's say I've decided that right here would be where I might need to do that. Boy, computer's not working great today. There we go. Now we're seeing. See, here would be over the 10 watt, um, the delta. Let's say that I had picked this as a point for a downside adjustment. And normally I'll pick those ahead of time based on what the P&L will be at various points and what the delta might be, and then I'll make it worse in my head, if you know what I mean. I'll say, well, it would actually happen a little bit higher than that point. So,
Yeah, because vol is going to increase.
right, because the volatility. That's generally how I would pick my downside adjustment point. When we get there, I'm going to start with a put debit spread to cut the delta in half and to either straddle the money with the long and short or be just out of the money by a strike or two, depending on, I guess, how fast the market's moving at that time. And if I um, I like risk reversals, where you do a call credit spread to pay for that.
Right.
But then I'm having call credit spreads on, and if we have a V bottom, that's going to get threatened. And here we are. Here I am again, being mad that I put on call credit spreads. So it generally won't do that. I might. I always consider it, but I generally won't do that. Instead, what I might do if I want to pay for it is put on a very low put credit spread out of the money, way down here somewhere, if I can get enough credit for it. And if I can't, then I'll put the put debit spread on, and that'll be my adjustment. Because what's important at that time is to get your adjustment more than to reduce the price that you pay for it.
And then the next steps was, say the market continues lower and your put debit spreads get close to being maxed out. Like say you sell a $20 spread and now it's trading for $17.
Yeah.
That spread's not helping you much anymore. It's basically turning into more potential risk if the market V bottoms. So would you roll those down or put more of them on, or what's your approach if the market keeps moving and those debit spreads start getting maxed out?
I do both of those things. So first of all, I will have picked the next point for the next one, down further down somewhere. And we get there, I'll put another one on with the same criteria: we'll straddle the money or be just outside of the money. Meanwhile, all the way down, I'll be watching the first one that was put on up here somewhere. And when it gets into that condition where it has realized about 80% of the maximum profit it can reach, which for a 20 wide would be, if it quotes
About 16.
Yeah, 16, then I'm going to probably harvest it. I would take it off and then add another one just outside of the money to replace it with, so I get my deltas correct and my downside protection correct. Right. Someday I'll do I have a slide or two about that and an analysis of where you should put your debit spreads and when you should do that kind of thing. And someday I'll go over that again, because it's good knowledge, it's good information, it's a good tool to have in your head.
And then at what point will you kind of throw in the towel and just chalk it up to a bad market experience and close it?
Right, the whole trade.
Yeah.
So.
Or do you? I mean,
I
maybe
do.
just keep rolling it down. Yeah.
No, I'm not going to fight it forever. Again, you could, if your delta is neutralized and your P&L hasn't gone past maximum loss, and you're way down here somewhere, you could, in theory, keep fighting the trade. But to me, it's not worth it, and I'm not going to do that. Partly because, if you remember, when we opened the trade, we were up in here somewhere, probably a good 3% or 4% above our shorts. And if we get down here, it means the market has moved 5 or 6 or 7%, something like that. So if we get down here and I've done my put debit spreads along the way and I've neutralized my delta and I haven't exceeded max loss, if all those things have happened, then I'll wait here for a day or two to see if there's going to be a V bottom or recovery back into the 10th where I will continue to manage the trade. And if it doesn't happen, if the market stays here or goes down further, then I'm out. Whatever the loss is at that point, I'll take it and I'm out.
And then you mentioned max loss. What are you using for that?
So for years, I have used a max loss of $200 per watt, be $2,000 on this one, on the theory that occasionally we can make $200 per watt, so there'd be a 1-to-1 profit target to max risk ratio. And also on the theory that these should win, I don't know, 80, 90% of the time, something like that. So it's reasonable to have a higher max loss because of the lower percentage of losers. Well, in the market in the last year or so, I'm kind of realizing that might be a little high. That might be letting it get too bad before I take it off. Because number one, when it hits that max loss, we're probably having a big move and the volatility can take me way past that real fast, So now I'm using about 150 a lot, 140 a lot, something like that.
So say you have your max loss and you put a trade on, and because the road trip's usually most vulnerable near the open after you put it on.
Yeah,
So you put the trade on, and bad luck right at the top, and the market starts selling off, and it has a big move down, and the vol spikes, and now you're like, say way past your max loss just from volatility, but you're still inside, the main part of the tent, maybe not even to the short strike yet.
yeah.
What's your thoughts about the continuing or discontinuing the trade at that point?
So, I've been in that situation a few times over the last couple years, and I have tried not exiting, you know, because in theory that vol has to come out sooner or later and it has to get back to the expiration line and all that. In theory, you'll recover that. But every time I've done that, the P&L gets down to max loss or past it, and it takes forever to recover, you know?
Right.
So I don't do that anymore. When you hit max loss, I'm out of there. Now, if it's early in the trade, like say a week after I had put it on, we're going to chalk that up to unlucky conditions or whatever you want to call it. But it's early enough that I probably will put a new one on, repositioned with all the entry rules somewhere up here outside the tent, and continue with that trade and that cycle. It's useful to do that, but only if you have, say, more than 45 days or so left.
So would you ever roll down the position, or would you just more lean towards taking it off?
These days, I've leaned towards taking it off. I have also rolled down in the past. That can be difficult as well because in the roll, you typically are locking in a loss. And
Right.
now you're in a position where you need to recover it again, and it takes forever, and it may never recover it. So I generally probably won't do that.
Yeah, from my back testing, from my initial back testing with the road trip, that's kind of what I found, that usually exiting is the better way to do it. And I did that with the capital I'm trading at LEF for, I think it was October when the VIX futures went into backwardation. I just closed all the road trips, and that was right before that 20% decline.
Yeah, right, right.
So I
And
kind of use that, the VIX term structure, as a guideline of when to be in or out.
yes, and that I do too. And that's a very good thing. And it can give you some lead notice, but it might only do it by a day at the most, so you need to see it and check it every day and act if you're going to act on it. My alert status on that is when it gets below about 3%, the percent contango
Hmm.
gets below about 3%. That's red alert territory for me. And it certainly means I'll be putting a hedge on against my portfolio if I didn't have one. And, high alert for problems with these trades.
So we know how Dan's performance has been because, obviously he's been running the trade alerts, but I'm sure people are curious how your trades have been going over the last, say, year or so. We've had some struggles with the markets with some volatility, and just
Yeah,
curious how your performance, do you track it in a spreadsheet, or how do you do that?
I do. I'm not prepared to bring that up right now because I didn't prepare. I have to do a little preparation to show that kind of thing. But I do
Right.
track it all in my trade log tracking sheet. I had some big losses in,
November, December, I'm guessing.
I think I did, yeah. And also, didn't we have it like May this year or April or something? We had a lot of trouble.
Yeah, we've had some volatility.
Yeah, I had some losses then as well. But generally, if you look over like a 2 year period, I have a lot of winners and I've been happy with it.
So overall, you'd say for the year, say 2018, or maybe the last 12 months, you've been in the black, it sounds like.
For the last rolling 12 months, I'm probably not in the black on my road trips because of that loss we had in April or whenever it was. And I didn't trade it for a month or something like that, so I lost some time. And uh, but if you take that one out, I believe I believe I would be able to say I'm in the positive all the time.
Even if you left it in, I'm sure the losses weren't that big, were they? I
They
mean,
weren't.
overall for the year.
they were max loss, and that's within limits, and that's what we're trying to do is manage our max loss. You know.
Right.
Yep. They hit max loss and they took them off. That's what happened. So yeah. Yeah, I'm sorry I'm not prepared to show that, but I certainly can. But I'll have to prepare some slides on that.
No, that's fine. I'm just I have to look and see what Dan's performance was. Let's see. Let me just take a quick peek. If you go to my.airmere.com/performance, it'll pull up all the trade alerts that are open. So it looks like Dan's peak from a $125,000 account, it peaked out at 155 and bottomed out at about 120. So it's about a $35,000 loss on 155.
Okay.
So let me get a calculator here. So, let's see. So 35 divided by 155. That's about a 22.6% loss. I'm guessing, though, because the way you trade is differently, your peak to trough drawdown was a lot less than that.
I would guess that as well, but again, I'll have to do the analysis.
You don't have the actual numbers, yeah.
Not in front of me, yeah.
Right.
Yeah, the other thing to remember is this loss that happened this year. I was trading a fairly large size, and they all went to max loss. So the dollars are big, but the percent or the max loss is controlled and within limits and what I planned for, right?
Yeah, I mean we're all interested in the percentages, not the actual numbers.
Yeah. Okay. Right.
Because percentages scale to everybody.
That's right. Yep.
And then as far as the futures, my accounts were going okay, and then Leslie wanted to kind of change the strategy up a bit because we really like the stratagem trade style of kind of limiting risk. So Leslie wanted to refile the disclosure doc to be able to do those kinds of trades with the CTA. So he asked me to be flat, and we're waiting for FINRA still, but I definitely intend to do more road trips once the disclosure doc is approved, which he's hoping is this week. I will be doing the futures on currencies initially, but I did have a conversation with Daniel, who is the developer of the software I'm using, and I asked him if he could add ES to it. And he said it wouldn't be a problem. He trades FX personally, and he's never needed the ES data, so all he needs is the data. So once he gets that software to me, which he's promised to be this week, then I should be able to add ES to my futures option positions, including some ES road trips again. So that will be based on expert charts signals. So that's all coming as far as the road trip futures part of the equation.
Cool.
For me personally, I like the risk reversal type of strategies or even long calls. I look at Adam Grimes a lot too to see what his calls are because he's actually pretty accurate. So if Adam's saying, "Oh, the market's very bullish or very bearish," then those will be the times I'll either add verticals or long calls or puts, depends on the direction, of course, to get some more deltas in the right direction. But those kinds of trades I like to bolt onto a road trip. But I'm always wary of the risk. And Robert Chastain had a nice concept in Florida when Leslie and I were there called a kill shot. And basically the idea is you know what your max risk is, so you set up trades to offset that completely, and you have that trade ready to go. So you're just ready to hit the transmit button in IB or whatever it is in TOS, confirm, I think. But that trade is all queued up, ready to go. So if the market starts, falling off the cliff, you can just hit the button and neutralize all your deltas. Your risk is gone, and then you can think clearer. Because that's a problem in a fast market. You start getting panicked, and you don't know what to do, and then the bid-ask spreads get super wide, and it gets even more confusing, and fills get difficult. And if you have something you can just go click and neutralizes the pain, then you can think clearer. And I thought that was a great concept.
Yes, right. And it fits in with the concept of always know ahead of time what your next move is. It fits in with that.
Well, it's like flying an airplane, right? You want to stay in front of the airplane, not behind it. So.
Right. That's right.
So let's see what else with the road trip.
I should show my September 20
Yeah.
for a minute. Let's leave this one, and I'll bring that one up.
And I see Robin's question, have you ever tried the Infinity Trade by TheoTrade? I'm not familiar with that, so if anybody has a little overview of that, that'd be great. But I don't know anything about it personally. Do you, Tim?
I don't, no. So this is my 20 September road trip, and I opened this. Let's see if it'll bring. My computer's being slow. I got to work on my computer. It's too slow. I hate it. Opened this one on July 2nd, so it's not too long into this trade so far. And as before, I open it with a call credit spread, but note that I only did one. I'm not doing two or three, and I'm not doing. I'm just not going to build a hole up here, you know. But and note also that it was an 8 lot. I have every intention of expanding this to a 10 lot, and I'll look at that even today, in fact. But I don't think it'll be today. Anyway, it's pretty much within the sweet spot, so there's nothing to do. And it's, if you look at the Aramir home thing, the daily planner, this table I have for the 20 September, I have filled in what the points are at which I'm going to do the reverse Harveys and the risk reverse or downside adjustments. Now, I want to comment on that for just a second for those listening. When I open a trade, I will fill these in because there has been no adjustments done yet. But if we're in a trade like the 16 August, you know, I started out on this path and then quickly got away from any resemblance to just doing simple reverse resistance 1 and 2 and reverse Harvey's 1, 2, and 3. So I blank out these numbers here, and that's why there's nothing here. It's not that I don't have a plan. It's that it can't be put into the table simply like this, you know. So I try to narrate that in my commentary up here, which I put at the top every day that I do that. So just thought I'd point that out. Anyway, this trade, there's really nothing to do at this point, and we'll follow those targets in the table at this point for the reverse Harvey, which may be coming up if we go up very much more, because we're only about 20 points, I think, away from that target, and the delta is already getting negative. So if we go up, say, 20 points, delta is even more negative, and this will be about the time to do a reverse Harvey.
So your short strikes at 31.25, still pretty far away.
Yeah, I put this further away than normal and took a bit less credit with that in mind because I really just don't want to fight these calls. You know, it's what gets people, what gets people in trouble the most, right? When you're an iron condor trader, is it the call side or the put side?
Well, they both do.
Well, they both do, but in my experience, it's the call side that I'm always fighting. You know, so I don't like doing call credit spreads if I don't have to.
Well, I think markets generally go up more than they go down. Just when they go down faster.
Right, right. So
that was kind of the benefit of the weird or, basically taking iron condor and selling less calls because, you're typically fighting the calls more than you're fighting the puts.
That's right. Yeah, and that was an excellent strategy, right? The other thing I should say about this, the reason that I'm willing to do this currently on open is, well, there's two reasons. One is I got some credit for it, which raised the line all the way from here down to forever, basically, and that brought my line up to a nice little tidy 360 above expiration right at the bat. But also because a call credit spread gives you negative delta, and I wanted to adjust my delta down a little bit from what it would have been had I not done that. I don't know if I can show that now. I think it was higher than that when I opened it, and so this brought it down a little bit. I'm trying to keep my delta pretty close to 0 actually lately. And the other main reason is I know that if this gets threatened, and when we reach the criteria that Dan used to use, and I basically use the same criteria,
like the mark to sale ratio.
Yeah. Then I can roll this one lot, call credit spread up without losing too much money on it. And in my August 16 trade, I've done that twice already, but I'm not willing to do it more than 2 or 3 times. So we're within the limit of safety, I guess you could say, on this call credit spread at this point, because I haven't even had to roll it up yet. So
Just a question on the August 16th. I know we've gone up, like you said, 200 points. That means some of those puts that you've sold have lost a lot of value. Are you going to close some of those to maybe free up the margin and sell some things a little bit closer to the money, get some more premium, or is your philosophy just kind of, let it go?
So I do that sometimes, and I have been watching these. At least I think it was yesterday. They weren't they weren't cheap enough for me to do that. I guess that was 2 days ago. But if they get really cheap, I'll consider it, especially if I have dug this hole a little bit deeper than I would like. And this hole is about as deep and wide as I would like it to be. I'd like to not expand that further, by selling a put credit spread up here or something. But the general rule is same as it is for those debit spreads. When that credit spread has reached 80% of its maximum profit, that's the time to do that, whether you need to or not, because they're cheap and they're not helping you very much going forward.
Well, like if you bring up the option chain, for example, let's if we take a look at it.
Right. So let's look at like the 2740. Let's see, 2750. I have a short there, and I have one at 2770. So we'll go to August 16th.
Oh, there's a lot of expirations these days, isn't there?
Oh, there sure is. Didn't used to be that way.
Yeah.
But I'm dating myself. Okay. And we're going to go to the 27. Oops.
Isn't there a column you can put on there with your positions?
I don't know. I've never. There might be.
I think I've seen Scott do that in his Thinkorswim.
Oh, actually, yeah. You get those little red and green things.
Right.
Yeah. The problem is this particular trade is not in Thinkorswim, so Thinkorswim doesn't know what I have.
Oh, okay.
Yeah, but yeah, that's there, and that's nice when you're doing it. So here's this 2770/2750, and if we just look at what it costs, fix the strikes, 85 cents. So
that's for a $20 spread.
Yeah,
it's pretty much maxed out, isn't it?
It's pretty much maxed out, depending on what it is that I actually sold it for. But I'd like to not lower the line by $90 even right now, and it's pretty far out of the money, so I'm leaving it there. But,
right.
But you're correct. That is something to watch for if you want it.
And then your lower longs are like what, 2600 range.
Yes, they're at 2610. Let's look at those. So I've got them at 2610. And
25, what, 90 something, 95?
95, yeah. Right, 25, 95. 20 cents, right? So that means a couple of things. That means the capital control adjustment is now 20 cents or less. And earlier in this trade, it was like $1.10, And in fact, when I first did it, I think it was about $1.10, and that was painful. But now they're so cheap that, I wouldn't even think twice about doing that adjustment.
Yeah. But your philosophy is just kind of let it sit, or versus just buy some of them in and take some of the risk off?
Generally, I'll let them sit because they generally don't hurt you, and we're so far above the market. In this case, I wouldn't. When I say don't hurt you, I guess what I mean is always look ahead to either your target exit date or maybe a week to expiration. And you can see that this hole here that I've dug with these put credit spreads, if I go this far in the trade, actually doesn't hurt me because the expiration line is still above zero and still profitable at that point. That's what I mean by that. So before you get too excited about the risk here, take a look ahead and see what the projection is, and see if it's actually hurting you. At some point it will, but
obviously volatility will increase if it goes down that much.
Right. And I still will have to have made my downside adjustment. That's true.
Right.
It actually looks like right here it's starting to hurt because the theta is going negative. Yeah, day by day from here, it's probably getting worse. Yeah. So anyway,
But if it's moved that far, it's probably moving a lot and probably wouldn't sit there, I'm guessing.
right, right. So I don't generally worry too much about those, especially because of that. And again, I don't want to trade too much either here. I want to, have this trade work. I want it to be road trip,
Right.
but it is something to watch. You need to watch what you've done here in this situation.
But certainly, if you need to reduce your margin, those lower puts are so cheap. You could easily put on some long put spreads for hardly anything and cut that risk quite a bit, pretty easily.
Yeah, yeah. And just to comment again, you can buy some shorts and sell some of these longs here, a wide debit spread like that, probably for pretty cheap late in the trade. Um, and that cuts your margin and takes your risk out and everything, but it also makes it more complicated to exit if you're going to exit this all in one day, because now you don't have a 10 20 10 type thing. You have a, 6 12 6 and a 4 8 4 with different strikes. It gets much more complicated to exit if you're doing it all at once, and I try to keep it simple as far as exiting goes as well.
So it sounds like you try and keep the original butterfly intact so it's easier to close, and then the adjustments are different strikes.
Yes.
Okay,
Yeah.
fair enough.
So okay, well, boy, that's a lot of stuff really fast. We
Yeah.
should probably take the time to talk about some of that in more detail as to what I'm doing, but we can do that. But that's my philosophy somewhat and my approach on these. I'll come back to them.
Well, you see Gary Whitlock's here. Hi, Gary.
Hey, Gary.
So I know Dan has worked closely with Gary on the G tool, and I'm sure he'd be willing to add or modify things on the G tool to suit your style of trading too, Tim. So if there's something you'd like changed, I'll put you in touch with Gary, and the two of you can put your heads together and see if you need to make any changes.
Yeah, we talked a month ago, and he made one change already that I asked for. Let's see if I can demonstrate that. I'll just pick this one. I wanted it to reflect my 3,000 per lot maximum limit.
Mm-hmm.
So and I think you put that in, and you see down here at the bottom, you see the criteria, and he put this right here, maximum risk limit per lot of 3,000. He added
Right.
that. Thank you very much, Gary. You did that really fast and really, really excellently. And so now what happens is in these rankings, there should never be more than 3,000 per lot. So if this is a 10 lot, that's less
So
than 3,000 per lot. And I think every one of them should meet that, And,
yeah, if it's programmed that way, it definitely will be that way.
right. So I that was the enhancement that Gary did already for me.
And that's another point with the road trip. If you like the road trip and you're comfortable with it doing it on your own, you can just subscribe to the G tool, because that's quite a nice report that comes out, or series of reports that comes out every day. And I really like Gary's grading there, like 8 of 8, and then you've got a pretty good candidate.
Yeah.
And Dan and I spend we've saved countless hours, looking at positions in like option view or whatever your option analytics of choice is, just by going quickly to the G tool, finding a nice looking one, pop it in, and say, oh yeah, that looks pretty good, or maybe just tweak one or two of the strikes, and you're good to go.
Right. And we used to do it manually a long time ago, right? Remember that,
Oh
Tom?
yeah, but Gary's taken so much of the work out of it. Like I said, if you trade the road trip, but you don't need to subscribe to it for the real-time alerts. This tool is a really good idea to have, because it's very time-saving.
Yeah. Yeah.
And then David has a question. Tim, how do you use the G tool when you're picking your entries?
Yeah. Hi, David. Thanks for joining. Um, I do use it because number one, it saves a lot of time, but I don't blindly, I don't take this. I don't say, okay, I'm going to do that one. It's ranked number one, and it's lot size is good and all that. Instead, I will look in here, and I'm looking for a few things that I want, but generally I want it. This is a good one. Of all these are all great statistics that you put in here, but I generally look at this one. I want it to be pretty high, and there's like this one's not that high, so I wouldn't even really consider this one at this point. But then I'll go work this up in Thinkorswim and have a look at what it is. And for example, if we're at all-time highs like we have been recently, then I will also look at one with the strikes being 10 or 20 points lower, and if I find, like I usually do in a market like this, that 10 or 20 points lower across the board, all three strikes could be done for even or 10 cents or pretty close to this, then I might feel safer with the strikes being lower because they're at all-time highs. And that's in fact what I did on my 20 September trade. But many times I'll end up with exactly what you see here, but I'm doing a little tweaking to just make sure that it fits with my outlook and my feeling at the time. But this makes it really easy. This does a lot of the work, and I love this tool. And so great job on that. Thanks, Gary and Tom and Dan, for putting that together.
Well, I just added a little bit. It was mainly Dan and Gary that came up with it, and Gary did all the heavy lifting, of course.
Yeah. So, yeah.
Good product.
I don't currently have more suggestions, but we may come up with something. But Gary, thanks for working with us on this, and we'll go forward from here. This is an excellent tool.
So, Tim, anything else you want to tell people about the road trip service that you're running, and maybe changes from how you do things versus what Dan did?
Well,
I think we've covered most of it, but just
yeah,
before we wrap it up,
I guess I'd like to send out a poll or something sometime about what do you want, because like some of the feedback that we got 6 months ago was too many layers or too much stuff, and so I just want to be sure that what I'm doing is in line with what people would like to do or want,
I suspect what people really like is a trade that you put on that you don't have to make an adjustment every other day.
Yeah. But then I worry that people are getting wondering why they're not hearing from me for several days in a row.
Well, if you update the planning notes, they hear from you there that way. But
That's
as
true.
long as the trade's working okay and not in trouble, I update the images every day, so it's people can stay on top of it. But they don't want they're not day traders, so they don't want to be like Dan had that recent trade. I think it was either the June trade or May, with like over 100 legs for that one trade.
Yeah, right. I'd like to not get into that.
Yeah.
Well, and then I just to say, I do try, if I'm going to make a trade, I try not to do it in the last half hour or something like that, so that people don't have time to look at what I did and just analyze it. I try to do them in the morning when there's more time for that. But sometimes you have to do it when you have to do it, but most of the time I'll get them out earlier than that.
Right. All right. Well, I don't see any more questions, and I think we've gone over pretty much everything we wanted to cover. So if there's nothing else, why don't we wrap it up, Tim?
Okay, very good.
All right. Well, thanks everyone for coming, and now you've kind of seen the transition plan from Dan to Tim. I think it should be a nice, smooth transition. So far, it has been. So thanks everyone for attending, and if you have any questions, go to roadtriptrade.com or just on the Aramir site. There's a link to it on the live trading. So with that, thanks again, Tim. Really appreciate it, and look forward to working with you longer term in the future.
Okay.
All right. Thanks, everyone.